Good evening, students. I am CA Ashish Vahel, and today we will be discussing Chapter 4, that is Risk Assessment and Internal Control. So, before we start, students, tell me how are your studies going? Please let me know. You have already done three chapters, first three chapters of auditing. So, how are your preparations going? Tell me, post your replies, and if there are some issues, your concerns, do let us know, guys. Okay. So, guys, you have already read about objective of audit. So, what is the objective of audit? You have already read. You have already read about audit planning, audit strategy, audit program. You have also got a basic idea about audit procedures, about various assertions. So today we will go a step further and we will discuss risk assessment and internal control. This is chapter 4 and it is one of the most important topics in your syllabus. Okay, and it will go up till your finals. Okay, guys. So understand the topic and do not hesitate to post your queries. Send your mails regularly. Okay. So shall we start? Are you able to hear my voice? You are able to see me? Do let me know, guys. Do let me know, guys. Are you able to hear me clearly? Yes, I got your mail. So shall we start? Many people have joined. Many of you have joined. Okay, thanks for the interest shown, guys. So today's chapter is risk assessment and internal control. Guys, remember whatever we would be studying in this chapter, it is in context of essay 315. It is in the context of essay 315. So what is the name of this essay? 315. It is identifying and assessing the risk of material misstatement through understanding the entity and its environment. It is a fairly long name, but guys, you have to remember when we get a long name, you can understand many things out of that name. Okay, so the heading of this essay 315 itself is self-explanatory. It throws light on many of the aspects which we are going to study in today's topic. Okay, so guys, risk assessment. Now, what is risk? So leave auditing. What is risk? In general, something negative. It is generally used in negative connotation. Okay, so it might be a security risk. You are going outside and somebody is going outside and there is a possibility of meeting with an accident. It is a security risk. So likewise, you can make n number of risks. There are business risks, there is security risk, there is health risk, there is finance risk. So similarly, guys, there is an audit risk. So what we will be studying in this chapter is only audit risk. You have got a basic elementary idea of what is audit risk in chapter 1. But in this topic, in today's topic, we shall be studying this concept of audit risk in greater detail along with its components and how it is relevant to auditing and to an auditor. So you understand what we are going to study today. So audit risk, as I told you guys, audit risk means the risk. You can broadly understand risk of failure of an audit. First of all, let me Can anybody of you tell me what was the objective of an independent audit as you have studied in chapter 1? Send me your mails. What was the objective of an independent audit as you have studied in chapter 1? What was the objective? Tell me what is the objective? What is the objective of an audit? The objective of an audit is to obtain a reasonable assurance that financial statements as a whole are free from material misstatements. So when the auditor obtains a reasonable assurance, he has to give his opinion. He has to express his opinion whether financial statements as a whole are free from material misstatements or not. Okay, so these misstatements may be due to error or fraud. So this is what we had studied in chapter 1. There are no issues in that. You are fairly clear about this thing. Is audit risk. So auditor are materially there are material misstatements in the financial statements, either due to error or frauds. But even then, the auditor gives an opinion that these financial statements are not materially misstated. So this is the risk which an auditor carries. This is with the okay. So you can broadly understand it is the risk of failure of an audit. It is a risk that an auditor expresses an inappropriate opinion when financial statements are materially misstated. Say there are mistakes in financial statements either due to error or fraud, but even then auditor has conducted the audit, he has applied the audit procedures, but even then he gives his report that the financial statements are not materially misstated. He gives unqualified report, gives and fair opinion. Okay, so you now broadly understand what do you mean by audit risk. What is the meaning of audit risk? The meaning of audit risk in layman's language, you can understand it is the risk of failure of an audit. So you can understand it is the risk of failure of an audit, that the objective of audit has been defeated and the auditor expresses an inappropriate opinion when financial statements are materially misstated. Okay, guys. So you are clear about what we understand by audit risk. Is that clear? So many of you are stating that video is buffering. So it might be due to some internet connectivity issues. It would stabilize with time. Okay. So now when we say, guys, that there are misstatements in the financial statements, whether due to error or fraud, so what do we mean by misstatements? What are misstatements? So now we will understand what are misstatements. Say first of all we will understand it with the help of an example. What are misstatements? Then we will come to its actual meaning, what is written in your module. Misstatements. Say, guys, take an example that there is a company, the auditor is auditing the financial statements of a company, and say plant and machinery valuing at say rupees 1 crore. Okay, it is debited to machinery repair account. So where normally it should have been reflected in the financial statements, it should have been reflected under the head fixed assets, but it has been wrongly charged to revenue. It has been wrongly charged to profit and loss account. So what is its effect? So in this way, the profit of the company has been suppressed by rupees 1 crore, and fixed assets of that equivalent amount are not being reflected in the asset sides of the balance sheet. So the financial statements in this case are materially misstated because profit has been suppressed due to wrong classification. So, but the auditor say has not pointed out this. He expresses an unqualified opinion. He gives a clean opinion that financial statements are have been prepared in accordance with the financial reporting framework, and these reflect true and fair view. So this is the audit risk, that financial statements are misstated, but the auditor has not been able to detect those misstatements by employing audit procedures. Okay, and he gives an inappropriate opinion, he gives a wrong opinion. So this is the audit risk which is inbuilt in the process of auditing. Guys, you have already understood in chapter 1 that some audit risk will always remain. Look, we cannot completely eliminate the audit risk. Audit risk cannot be reduced to zero. Risk to the nature of auditing, the inherent limits of audit. Okay, so some audit risk would always remain, whatever the procedures, whatever extensive procedures the auditor may apply. Okay, so you now understand, guys, what is meant by audit risk and what is the broad meaning of misstatements. So we have tried to understand the meaning of misstatements with the help of this example. Now we come to what is written in your module or academic definition. Okay, so misstatements, guys, misstatement means misstatement means misstatement means that there is a difference either in amount or in classification or in presentation or in disclosure of a financial statement item, and which ought to have been reported in accordance with the financial reporting framework, like we have seen in the example which we have done recently. Here, the plant and machinery was wrongly classified and debited to machinery repair account. So it was a difference in classification. Okay. the amount of rupees 1 crore should have been reflected in the plant and machinery account under the head fixed assets. Rather, it has been charged to revenue account. So it is a misstatement. Now, this misstatement may be either due to error or it may be due to fraud. Similarly, there can be n number of examples. There is difference in some amount which is reflected in financial statements, but that amount is not correct. It should have some other amount should have been reflected and financial statement that organization are being, or there possibility that there is some difference in the presentation or disclosure. Say when we are making the balance sheet of a company, certain disclosures are required to be made in accordance with Schedule 3 of Companies Act 2013, but these disclosures have been wrongly made. So you can remember from the examination point of view, you can prepare an acronym ACPD. ACPD stands for Amount, Classification, Presentation and Disclosure. Say whenever there is a difference in any amount, classification, presentation or disclosure of a financial statement item of an item reported in financial statements and which ought to have been reported in accordance with the applicable financial reporting framework. So that kind of difference we refer to as misstatement. Okay. And the misstatements, guys, you have to remember it is very, very important from examination point of view that misstatements may arise from either from error or due to fraud. So misstatement which has arisen due to error, it is also a misstatement. And if it is fraudulent, even then it is misstatement. Okay. Errors, as you understand, guys, errors are unintentional mistakes, genuine mistakes, and the frauds are deliberately laid out scheme of things. These might be committed by the management or by employees of the company. Okay, so you understand, guys, what do we understand by misstatement? So audit, again we are coming back to audit risk. So audit risk is a risk of an auditor expressing inappropriate opinion when really misstated. Say the financial statements have come to the auditor for auditing and he gives his opinion that these are not materially misstated when in fact these are materially misstated. So this is the risk which the auditor carries. This is the risk which an audit process carries. Okay, guys, is it clear to you? Let me know. Yes, guys, please let me know. Is that clear? Audit risk is clear to you? So, guys, there are two components of audit risk. Audit risk is formed of two components. One is risk of material misstatement and another is detection risk. Now we will study in greater detail what do we mean by risk of material misstatement and detection risk. So first I will like you to understand the meaning of detection risk. First, I will like you to understand the meaning of detection risk. So guys, detection risk means that the auditor is not able to detect material misstatements in the financial statements even after employing the audit procedures. So it is the risk of not detecting. Say there are some errors in the financial statements. For example, say if there are some errors in the financial statements and the auditor has employed audit procedures for checking those financial statements, and those audit procedures are not able to check those, to reveal those errors. So this is the detection risk. Okay, so this is the detection risk of not detecting. So although the name is detection risk, but you have to understand it is the risk of not detecting. It is the risk of not detecting material misstatements. Although the name is detection risk, guys, you have to understand and you have to hammer it into your minds, because sometimes we get confused between the terms, because the term is detection risk. However, its meaning, its nature is risk of not detecting. Risk of not detecting. And now we come to risk of material misstatement. So it means that financial statements are materially misstated. There is inbuilt risk in every financial statement. There is inbuilt risk that financial statements are materially misstated. Now, this risk of material misstatement also consists of two parts. So academically, we can break risk of. So what are those two parts that we are going to study now? Now, risk of material misstatement consists of two parts. It is inherent risk and another is control risk. Now, guys, what is inherent risk? What is the meaning of term inherent? Inherent means coming from within, जो कि किसी चीज के अंदर से आ रहा है, which is coming from within. So inherent risk, like some transactions by nature, these are risky than another kind of transactions. Say cash transactions are always riskier than those carried through banking channels. Some industries are always riskier than another kind of industries. Okay, due to nature of business or due to various factors, like in some industries, products might be getting obsolete faster due to changes in technology. So all these conditions, so these type of risks are known as inherent risk, which are there uh, in the very nature of the transactions which are being reflected in the financial statements. Okay, so it is clear to you guys what we mean by inherent risk. Inherent risk means risk which is inbuilt, which is because of the nature of the transaction. It is coming from within. It is untreated risk before any control. Before any control has been employed by the organization, it is that risk is known as inherent risk. Okay. Okay, guys, I've given you the example of inherent risk also. Say in case of some transactions, while these are being reported in the financial statement, some estimates might have to be made, like some complex calculations might have to be made. So if that item involves lot of judgmental issues or complex calculation, obviously it carries a greater risk than another transaction which is quite straightforward. So on which no judgments are required to be made by the management. So obviously there are certain transactions which carry greater inherent risk, and there are certain transactions which carry lower inherent risk. Risk would always be there. It is only a matter of degree. Okay, guys, so you understand what do we mean by inherent risk? Is that clear, guys? Please let me know. Please let me know. Post your replies. Is that clear? What do we mean by inherent risk? So, guys, now we come to control risk. Now, what is control risk? See, guys, to function, every organization, every company, they have to devise a control system. They have to devise a system by which organization, the company, it can perform its function efficiently and effectively. And such kind of a system has also to ensure that whatever is reported in financial statement, it is reliable. That whatever figures are being reported in financial statements, these are reliable. So such a system which is devised by the management to ensure that financial statements have been prepared in accordance with the applicable reporting framework, and the figures reported give a degree of reliability, and the functions of organization are carried out efficiently and effectively. Such a process is known as broadly internal control, which we would be studying in greater detail within this chapter. However, for the time being, you can understand what is internal control. You might have read it in earlier chapters also, some basic idea. Now you can broaden it up. So we will also refer to internal control system broadly as controls, for sake of easy understanding. Controls which have been devised by the management to ensure reliability of financial reporting and to ensure that organization carries its operations efficiently and effectively. Okay. So guys, there would always be a possibility that controls do not work properly, or say the management has devised a foolproof control system, say for purchases, and some employees have colluded and they have bypassed that control. So there would always be a control risk. Control risk also cannot be zero. Control risk also cannot be zero, because there is always a possibility of human error, and there is always a possibility of collusion. Okay, however, strong inbuilt controls the management might have devised, or there is quite a possibility that management itself might perpetuate a fraud. So what will you do then? So there is always a control risk. Okay. So there is always a control risk. So what is control risk? Control risk is the risk of failure of controls. You can understand control risk is the risk of failure of controls, or the controls not working properly, or controls are not able to detect some mistakes or frauds. Say the management has devised some control system in respect of certain transactions, but the employees have been clever enough that they have bypassed those control system, and those controls are not able to detect those things. So the controls have failed. So this is a risk in every internal control, in every control, that controls might fail, that controls are not able to prevent those misstatements, or if even if they have even if they have not been able to prevent, and they are not able to detect also. Okay. So so guys, you understand inherent risk and control risk. Now what is the difference between inherent risk and control risk? Now inherent risk, guys, it always comes before any controls are employed. As we have understood, inherent risk is the basic raw risk before application of any controls. It is inbuilt in the transaction. It is inbuilt in the transaction. Whereas control risk is that the transaction has occurred, but controls have failed, or controls have not worked properly. Okay, so this is the control risk. So both these risks, inherent risk and control risk, these form part of risk of material misstatement. So risk of material misstatement might arise either due to inherent risk and due to control risk. These are both components of risk of material misstatement. And say if the auditor is not able to detect, by employing the audit procedure, the auditor is not able to detect those material misstatements, then this is the detection risk. So guys, you understand all the three things: risk of material misstatement and detection risk. Risk of material misstatement again consists of two components. Number one is inherent risk, and number two is control risk. So these two are parts of risk of material misstatement. Detection risk I have already explained to you. Okay. So now we come to how these things are related to audit risk. Guys, do not hesitate to send your queries. Do not hesitate to send your queries, guys. So audit risk, if we try to mathematically formulate into an equation, into a formula, so audit risk is, guys, risk of material misstatement into detection risk.
Audit risk is risk of material misstatement multiplied by detection risk. Now, simply if you put two components of risk of material misstatement here, that is inherent risk into control risk into detection risk. So this becomes audit risk. So audit risk is inherent risk multiplied by control risk multiplied by detection risk. So guys, you have to understand that audit risk cannot be reduced to zero. Why? Now we will understand why it is so. You have already read it in chapter 1 that audit risk cannot be reduced to zero. It can be reduced, but it cannot be eliminated. Just fix it in your minds, guys. It is very, very important. While performing the audit process, and the audit risk will always remain. It can be reduced. The auditor, by employing extensive procedure, by doing auditing of all aspects, by increasing his area of checking, by increasing his verification procedures, he can reduce that risk, but he cannot eliminate audit risk. We cannot be completely sure that there are no material misstatements in the financial statements. Some risk will always remain. Some risk will always remain. Guys, you have to remember it. So audit risk cannot be reduced to zero. It can be reduced, but it cannot be eliminated. It cannot be eliminated completely. Okay. Why? Now, why it is so? It is so because there would always be some inherent risk in transactions. In financial statements, there are a lot of transactions. So there would always be inherent risk. Some transactions might be riskier, and there might be some complex calculations or judgmental matters might be involved. So inherent risk would always be there. Control risk would always be there. However strong control systems might be devised by the management or might be devised by an organization, but still some control risk would always be there, because you know the human nature. People will try to bypass the controls, or there might be situation that although they intend to follow the controls, but they are not doing it for the sake of some interpretational issues. They have understood the controls in some different manner. Okay. So there will always be a risk that controls have failed or controls have not been able to detect material misstatements. So some degree of control risk would always remain. Similarly, detection risk. So practically, guys, you have to understand that it is not possible for the auditor to check each and every transaction. Sorry, each and every transaction of the in which is being reflected in the financial statements, because in today's world, transactions daily runs in n numbers of transactions are taking place in every business. So the auditor generally tests the sample. Okay, so there will always be a possibility that even by employing audit procedures, even by increasing his area of checking, the auditor has not been able to detect misstatements. So detection risk will also be there. It can be reduced. The auditor would try to make it lower, but still it would always remain. So when none of these three factors can be reduced to zero, so some of the audit risk would always remain. Some of the audit risk would always be there. Okay, guys. So guys, I have tried to explain it in simple layman's language what is meant by audit risk and what is the relationship between inherent risk, control risk, and detection risk. Okay. So is that thing clear to you? I am not going to stop here for audit risk. I'll also give you some other examples for better understanding. But my request to you, dear students, is that do not take this topic lightly. This is very important topic, and again it will come in finals. And we have seen that students who reach finals, even they are not clear about audit risk and its components and what is the relationship between all these things. So that is why I'm trying to familiarize you with all these things. Okay. Okay, guys. So guys, we will also come to your module, but first of all, my effort is to make you familiarize with the concept, with the topic. We will come to module again. Okay, and your queries, all your queries, please keep on sending your mails. We will take it at the end of session or at the start of next session. Okay, because if I simultaneously start taking all of your queries, the topic will we will not be able to take the topic forward. Okay, all your queries, guys, I am seeing you keep patience. Do not worry. We will discuss each and every query. Okay. So guys, you have also to understand that audit risk is a matter of professional judgment. It is a matter of professional judgment of the auditor. Now, it is not necessary that auditor has to arrive at some formula to deduce the audit risk. He has not to arrive a figure. It can be a subjective thing, like the auditor might conclude that inherent risk in this case is low, or the auditor might infer that control risk in this case is high. So accordingly, or he might benchmark it on a scale from 1 to 10. So there is no fixed thing. It is a subjective thing, but auditor definitely has to assess the risk. Okay. And another thing you have to understand, that this audit risk has nothing to do with the say litigation loss or say loss of reputation of the auditor. It is a technical term associated with the process of auditing. So as we do auditing, we have to see, every auditor has his auditor's hunch. He has to see what is the risk when he studies the financial statements, or when he oversees the control system, he understands what is the risk associated with it. Okay. So it is clear to you guys, audit risk is inherent risk multiplied by control risk multiplied by detection risk. So guys, we shall also try to understand this whole concept of audit risk along with its components by taking an example from a movie. So that the concept is permanently ingrained in your mind. Say guys, you might have seen many movies in which robbers try to steal a diamond. Okay, so we shall try to correlate this whole process of stealing a diamond with audit risk. So say there is a diamond. So diamond is what kind of asset, guys? It is a costly asset. It has to be kept safe. So you can broadly say it has got a inherent risk. So if I am an auditor, I would assess the audit risk to be high. So this is an inherent risk in the diamond because it is a costly asset. It is prone to stealing. It is prone to stealing. Okay. And say the person who owns the diamond, he has devised all kinds of controls. He has devised all kinds of controls for what? For the safety of diamond, for the fact that diamond is not stolen because it is a valuable asset. So he has employed all kinds of control. Say he has employed a security guard. He has employed a 24/7 siren system. Besides, there is electronic surveillance also. Okay, so these are the controls he has employed. That is, diamond is not stolen. But there is a possibility that these controls might fail, like the electronic surveillance system might fail, or the security guard might become dishonest. So there would be a possibility that controls fail. So this is known as control risk. The possibility of controls failing is control risk. The probability, the susceptibility that controls will not work properly as intended. So this is known as control risk. Okay. Inherent risk is already there. Now say that this owner of the diamond, he has also deployed a security officer to ensure that he checks that whether diamond is safe or not. Now he regularly goes to the place where diamond is stored. Okay, and he carries out his own procedures, like an auditor carries out his own procedures. He also carries out his own procedures, but by carrying his procedures also, because other people are clever, so even his procedures are not able to detect any mishappening. So this is detection risk. So this is detection risk. And what is audit risk? Say ultimately he gives in writing to the owner, he gives in writing to the management that diamond is safe when in fact the diamond has been stolen. So I have tried to give you an analogy from a movie example. Hope it would help you in better understanding of the concept. Okay, guys. So this is, I think you by now you have understood the concept of inherent risk, control risk, detection risk, and audit risk. Okay. Guys, do tell me how you have found the example. And one more thing, guys, is that there is an, guys, you have to understand there is an inverse relationship. First, first I will prepare a table for you. Then we will come to this thing. Now say, guys, in some organization, in case of a company, the auditor of that company, he assesses that there is high inherent risk, that transactions are very risky. भैया बहुत risky transactions हैं, risky business है. So he assesses inherent risk to be very high. It is auditor's assessment. And he also assesses control risk also to be high. He says that controls are poorly designed. These might not work properly. There is a possibility that employees might bypass the controls. Okay. So tell me now, guys, from what we have studied, whether he would want to keep the detection risk low or high. Tell me, if the auditor assesses the inherent risk to be high in a company and control risk also to be high, the auditor has assessed that controls are not working properly and the transactions nature of business itself is very risky, and he assesses both inherent risk and control risk both to be at high level. So he would want to keep detection risk at high level or low level. Tell me, guys, whether he would want to keep the detection risk at high level or low level. First of all, remember meaning of detection risk. What was the meaning of detection risk? Detection risk was risk of not detecting material misstatements. That the auditor feels that material misstatements have not been detected, so he would want to keep that risk low or high in such a situation. Tell me, guys. Tell me, guys. Now I have got 4 or 5 mails. Charu, Hina, Harsh Goyal, Shivam Kumar. Now some of you are writing correctly. Few have have interpreted it wrongly. Now say the transactions are very risky, control risk is also high. So auditor would always want that his detection risk is low. So what was detection risk? It was risk of not detecting what I had told you at the outset, at the beginning. So it was a risk of not detecting material misstatements due to errors or frauds. So obviously he would employ vast audit procedures. He would increase his area of checking. He would increase the scope of checking to ensure that he would make sure that all material misstatements come to his knowledge, that he would try to increase his area of sample checking. Okay, so he would try to keep his audit risk as low. He would try to keep his detection risk. He would try to keep his detection risk as low. He would try to keep risk of not detecting material misstatements as low. What was detection risk? Risk of not detecting. Risk of not detecting misstatements. He would try to keep this risk at low level. It would only when he would try to keep his risk at low level, that his audit risk would be at low. Because if all these things are high, his audit risk would shoot up. So no auditor would want that he carries a high audit risk, that his assignment carries a high audit risk, that there is a risk of failure of audit in such a situation. So he would increase the area of his checking, he would employ vast audit procedure, and he would keep the detection risk at low level. He would want that all things are checked. Okay, so that audit risk remains low. So that audit risk remains low. Okay, so is that clear to you guys? Is this table, is this example clear to you? Say now we reverse the situation. Now we reverse the situation. Say the auditor in a company, he perceives the inherent risk to be low. Says the business बहुत अच्छा चल रहा है, it is very good business. Okay, there is no risk in immediate future, and controls, the management has taken the help of technology to design proper controls, so that if somebody tries to bypass those controls, he is immediately caught. So control risk is also low. So the auditor in such a case, he would be little easy sort of guy. He can keep his detection risk to be at high level. He would lower his area of checking, because by testing the controls, by seeing the transaction, he has understood that that controls are working properly, the transactions are not risky, so he can get a reasonable assurance even from small area of checking. Okay, even if the detection risk of not detecting, even if the detection risk is high, and even in that situation, audit risk would not be high, audit risk would be low, because the possibility of any control risk or inherent risk is very low. Okay, okay guys, so you have understood. I have again tried to explain this with a sort of table. It is not in your module, it is for just a better understanding. Okay, Okay, guys. So guys, you have also to understand that audit risk is not capable of precise measurement. I have already told you that audit risk is not capable of precise measurement. It is not a quantity which can be measured in specific terms. Okay, it is a matter of professional judgment of the auditor, and it is a technical term related to the process of auditing. And guys, you have also to understand one more important thing, distinction, that there might be some case that where financial statements are okay, financial statements are not materially misstated, but the auditor says that these are so. Okay, so, but this thing is not included in audit risk, because this risk is very insignificant. It has negligible possibility that financial statements are. What was the audit risk? Audit risk was that auditor gives an inappropriate opinion when financial statements are materially misstated. Now we consider a situation when financial statements are not materially misstated, financial statements are okay, but the auditor gives the opinion that these are materially misstated. So this thing, reverse of the definition of audit risk, is not covered in the risk of audit, in the audit risk, because this risk is very small. Its possibility that the auditor gives a wrong opinion on the reverse side is very remote. So you have to clearly understand the term, and this type of question can come in true and false type question. Question number 1, 2 mark question, which is coming into your paper. So this type of question can come. So audit risk does not cover the risk when the financial statements are okay. Financial statements have been prepared correctly. These do not contain any material misstatement, whether due to fraud or error, but auditor gives his opinion otherwise. Okay. Guys, when an auditor has to start the audit, when he has to perform an audit, he also tests control. So you have read in chapter 3, tests of control. The auditor tests all the controls which have been devised by the management. Like I have told you, while we have understood the meaning of internal control, that auditor also he has also to check the controls which have been designed by the management, whether these have been working properly or not, whether there is a possibility of these being bypassed or not. So when the auditor tests these controls, so he may choose to rely on those controls, or he may choose not to rely on these controls because of the observations he has made by testing those controls. Say if the auditor does not obtain a reasonable assurance that controls are not working properly, so he would not be relying upon those controls. Okay, so while doing so, the auditor checks those controls which are there in case of significant class of transactions. The transactions you can understand which are significant from the financial statements point of view. Okay, guys. So there are very simple small examples given in your module. I think what we have studied right till now in last 1 hour, it is sufficient to answer those examples which are given in your module. These are fairly simple examples, and you would be able to do these examples without first seeing the answers. So my advice to you students is, whenever you do some problem, whenever you do some situation, some case study, you first read, you first try to understand the concept, and then go on solving that problem or case study. And without first seeing the answer, do not jump to see the answer. Without first seeing the answer, first you try to solve it. First you try to solve it in your own mind, and then you should correlate what your mind has derived with what the answer is. So in by following that strategy, you would be able to improve yourself, and you will be able to highlight your deficiencies also. Okay. Guys, now we will also quickly make a recap from the module what we have studied, this whole subtopic of audit risk, misstatements, what are misstatements, components of audit risk, and their relationship, audit risk, inherent risk, control risk, and detection risk. We will quickly go through the module. Okay. So I will be sharing the screen with you. Yes, guys, you are able to see the screen. Guys, tell me, is it visible or should I enlarge it? Please tell me, guys, the screen is visible or should I enlarge it? Yes. So should we move? Now, guys, first thing is audit risk. Now, what does your module say? It says audit risk means the risk, the same thing which I have been repeating many times, that auditor gives an inappropriate audit opinion when financial statements are materially misstated. So this is the risk that auditor may fail to express an appropriate opinion in an audit assignment. Okay. So again, there is the same example. It is given here of the plant and machinery which we had done. Okay. Now it states that audit risk is a function of risk of material misstatement and detection risk. So there are two components of audit risk. One is risk of material misstatement and detection risk. Okay, we have already done it. So what is risk of material misstatement? Now risk of material misstatement is a risk that financial statements are materially misstated prior to audit. Now this word is very important. That before an audit has been carried out, it means that before an audit has been carried out, prior to audit, before audit, that financial statements which have been put up before the auditor for auditing, these are materially wrong. These are materially misstated before the audit. Okay. So it consists of two components. So what are those components? These are risk of material misstatement consists of two components. One is inherent risk and one is control risk. Inherent risk, guys, we have already done, we have already studied. Now what is written in your module? It is the academic language, auditing language. It means the susceptibility of an assertion about a class of transaction, account balance or disclosure to a misstatement that could be material before consideration of any related controls. So basically it says that there could be a transaction or account balance or disclosure. So guys, while you have read assertions in chapter 3, remember chapter 3 assertions, you have studied that assertions can be about transactions, assertions can be about account balances, assertion can be about disclosures. So the susceptibility means chances of getting it, chances of you can understand sensitivity, that an assertion, then that an item which is appearing in financial statement, there is a more likelihood that it is more, that there are more chances that this transaction or account balance or disclosure is prone to misstatement. There is likelihood of misstatement without application of any control. So what is the difference between inherent risk and control risk? Inherent risk is present there in the transaction due to very nature of the transaction before considering any control. Control risk comes later on. So it is there in the very nature of transaction. So it means the susceptibility of an assertion about either a class of transaction, some transaction, or some account balance or disclosure. Three things are there: transaction, account balance or disclosure to a misstatement which could be material, which is important, either individually, alone, individually, or aggregated with other misstatements or combined with other misstatements. When some misstatements, say one statement is small in itself, but when I combine it with other things, it becomes material. Okay, before consideration of any controls. So that is very important. Inherent risk is before consideration of any controls. It comes naturally from within the transaction. Okay, so this risk is known as inherent risk. Okay, and again control risk. Control risk is that again this assertion relating to what? Assertion relating to transaction, account balance or disclosure. Again, that could be material either individually or aggregated with some other thing. Okay, will not be prevented. That this misstatement will not be prevented or detected and corrected on a timely basis by the entity's internal control. So it simply means that entity's internal control system, it is not able to prevent, detect and correct any material misstatement. Like people, I have told you that people have bypassed that control, or some fraud has happened, but the control system designed by the management has failed. Like the example we had studied that electronic surveillance system in the case of diamond, it has failed. Okay, so it is a risk that controls deployed have failed. Okay, so control risk is a risk that internal control existing in an entity would not be efficient enough to stop from happening and then rectify in appropriate time any material misstatement relating to transaction. Okay, so guys, from what we can draw from this, what we can infer from this, say if the internal control system, the control system devised by the management is good enough, it is efficient, so what would be the control risk? What would be the chances that control risk, that people would be able to bypass those controls? Say if there are good controls, there are healthy controls, there are strong controls deployed by the management, then what are the chances that even then controls will fail? There would be low chances. So obviously then there is inverse relationship between a good control system and a degree of control risk. Say if the control system is efficient, possibility of control risk is low. If the control system is not running properly, if it is inefficient, then possibility of control risk will go high. It will increase. Okay, guys, clear? Tell me, guys, is that clear? So there is an example. So now we come to the definition of misstatement. Now, what is misstatement? What is misstatement, guys? Misstatement refers to a difference. This I had already told you, amount, classification. You can prepare an acronym, presentation or disclosure, ACPD. Difference between amount, classification, presentation or disclosure of a reported financial statement item and the amount, classification, presentation or disclosure that is required for the item to be in accordance with the applicable FRF, financial reporting framework. And this is also very important, guys. Misstatement can either arise from error or fraud. You have always to remember that misstatements may be due to error or due to fraud. If these arise due to error, even then these are misstatements. If these arise due to fraud, even then these are misstatements. So if there is a difference in the amount which is reported in the financial statements and vis-a-vis what was required to be reported. Okay, if there is a difference, what was the ideal amount to be reported, which should have been reported in the financial statements and which has been reported. So it is a misstatement. So similarly, if there is a disclosure which was required to be made in the financial statements, however, some inadequate disclosure has been made in the financial statements, that is also a misstatement. Okay, that is also a misstatement. So misstatement can arise either due to error or due to fraud. Okay, guys. So again, then the same thing, that assessment of risk, it is a matter of professional judgment. It is a matter of professional judgment and it is not capable of precise measurement. Okay. What is not included in audit risk? This I have told you that this risk is insignificant, that financial statements are in fact say financial statements are correct. Okay, and auditor gives the opinion that these are not correct. Basically, in layman's language, you can understand that financial statements are not misstated. These are correct. These are free from error and fraud, and auditor gives his opinion otherwise. So there is a very low possibility of such a situation being happening. So that is why this is not included in audit risk. This is not included in audit risk. This is not included in audit risk. Okay, and again, the audit risk is a technical term. We have already studied it, and it does not refer to the auditor's business risks such as loss from litigation, etc., adverse publicity. These are things. And guys, one more thing. Now the misstatement, these can occur at two levels. These can occur at two levels. These can occur at assertion level also and financial statement level also. Now, assertion level means you can understand at the transaction level in respect of transaction or account balances. However, there is a possibility that at overall financial statement level, there is also risk of material misstatement. We say when the material misstatements are so pervasive, these are spread across different transactions or across different account balances, then we say that there is risk of material misstatement at financial statement level. When the risk is restricted only to transaction stage or only to account balances, we say that risk is at assertion level. Okay, guys. So it should be clear to you. Is it clear, guys? Now, components of risk of material misstatement. We have already done, guys, that risk of material misstatement consists of two parts. It consists of two parts. What are those parts? These are inherent risk and control risk. These are inherent risk and control risk. Now, this goes on to explain again what is the meaning of inherent risk. This I have already discussed in greater detail. And this also shows what is control risk, what is the meaning of control risk. Example, the possibility of human errors or mistakes, or of controls being circumvented by collusions. So some control risk would always be there. There would always be some control risk, possibility of controls getting failed, controls not working properly. Okay. So this we have also studied. So when the auditor assesses the control risk, he verifies whether to rely on controls or not rely on controls. Okay. And he checks significant class of transactions. Okay. And this line is, guys, also very important. The essays do not ordinarily refer to inherent risk and control risk separately, but rather to a combined assessment of risk of material misstatement. Now, guys, you have to understand that essay 315, it states risk of material misstatement. However, for the sake of better understanding, we have broken it into two parts. We have broken it into two parts, inherent risk and control risk. Okay. So you have to understand that auditor has to assess the risk. What is important is that, what is significant is that auditor has to identify and assess the risk. Now, by whatever way he does it, that is not important. Which methodology he uses it, that is not important. It is important that he assesses those risks of material misstatement. So the so the breaking up of risk of material misstatement, which we have done into inherent risk and control risk, it is for better understanding, and it is part of overall risk of material misstatement. Okay. So here again, then formula is there. Risk of material misstatement is equal to inherent risk into control risk. Okay, and audit risk is inherent risk into control risk into detection risk. Okay, and it now states what is detection risk. Now, risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists either individually or when aggregated with other material misstatements. So again, the same thing. Detection risk means the risk that the auditor, whatever procedures the auditor has employed, these will not be able to detect a material misstatement that exists in the financial statements. Some material misstatement is already there in the financial statements, but the audit procedures employed by the auditor have not been able to detect those material misstatement which is present there individually or in combination with other misstatements. Okay. So detection risk will always be there. It is written in next para because the auditor, he works on the basis of test checking or sample checking. It is not possible for him to check each and every transaction. There are inherent limitations of audit. So some detection risk would always be there. So you understand, guys, you see this mathematical formula. Even if one of the things becomes zero, the audit risk becomes zero. But it is not so. But it is not so because inherent risk would always be there, control risk would always be there, and detection risk would always be there in some quantity, some little thing. All these factors, ये तीनों भाई बहन हैं सब, these will always be present. Okay, so audit risk will never be zero. Okay. So there are some simple examples given here. So we have done up till here, guys. Okay. So guys, I think you are able to understand the concept. Tell me, guys, you are able to understand the concept. What we have read up till now, have you been able to understand the concept? This will be ingrained in your mind when you will study it from your module with your own thought process. Only then it will get ingrained in your mind. Okay, this is not a one-shot affair that you give a simple plain reading and things would go into your mind. No, you have to study it and think over it and remember it. Only then you would be able to apply these concepts. Okay. Okay, guys. So at this stage, guys, we will take a short break of around 7 minutes and we will be coming back after 7 minutes. Okay. So see you after a short break. Yeah. Now, guys, welcome back. So, students, essay 315, standards on auditing number 315 is about identifying and assessing risk of material misstatement through understanding the entity and its environment. Okay. So essay 315 states that one of the objectives of auditor is to identify and assess risk of material misstatement. Now, the auditor has to do two things. First, he has to identify the risks. Okay. And he has to assess those risks. So he has to assess whether the risk exists at, say, assertion level, at transaction level, at the account balance level, at the disclosure level, or it is more pervasive. It relates to whole of the financial statements. So first thing, he has to identify the risks and he has also to assess those risks of material misstatement. He has to assess what could go wrong. What is the possibility that there is some important misstatement in the financial statements which could significantly affect the results of the entity. Okay. Now, how he does it? So he does it by understanding the entity. See, if I am auditor of a company, if I do not understand the organization, the company, its nature of business, the industry in which it's operating, or I do not understand about the operations of the company, how it is doing its business. So whether I would be able to do justice to my job, whether I can perform audit effectively, the answer, guys, would be resounding no. Okay. So that is why this understanding the entity and environment, it is very important. Okay. So the longer the name is, so if you remember the name of this essay 315 correctly, many of your problems, many of your issues would be solved. Okay. So as per essay 315, the objective of auditor is to identify and assess the risks of material misstatements. Two things are there. He has to identify, he has to pinpoint, and then he has to assess. He has to assess what kind of risk is it, whether it can distort the picture of financial statement as a whole, or it is limited to some area, whether it relates to few account balances or it affects other things also. Okay. So how does auditor identify and assess those risks? He assesses those risks by understanding the entity and its environment. So how does he understand the entity? He studies the internal control system also. He studies the operations of the organization of which he is the auditor. What is the nature of the business of the company? So by studying all these things, he is able to pinpoint those areas where there is a likelihood, where there is a possibility of potential misstatements. So again, those misstatements, these may be due to error or these may be due to fraud. Okay. So clear, guys? So this thing is clear to you? And Now, risk of material misstatement, as we have already understood, it may relate to financial statements as a whole, or it may be at the assertion level relating to, say, transactions, account balances, or in relation to certain disclosures. So what the auditor has to do, first of all, he would identify the risks. First thing is, he would identify the risks. Okay. Second thing he would be doing, he would assess those risks, whether these relates to financial statement level or assertion level. Okay. And then next third step, what does he do? He relates the identified risks to what can go wrong. Relation of risks to what can go wrong. And after he establishes the relation of risks to what can go wrong, he assesses the probability. He assesses the likelihood of misstatement. What is the chance of misstatement? What is the chance of misstatement? What is the chance, you can say, likelihood of misstatement? So academically, theoretically, we can break this process into these four points. That first of all, auditor identifies the risk, then he assesses those risks, whether he evaluates whether these relate to pervasively to the financial statements as a whole, or these relate to assertion level, and then he evaluates the relation of those risks to what can go wrong. He evaluates what is the relationship between assessed risks to what can go wrong, and thereafter he assesses the likelihood, the chance of misstatement. Okay. So how does the auditor does all these things? He does all these things by employing risk assessment procedures. Risk assessment procedures. Okay, guys. So risk assessment procedures, simply understood, are the procedures, guys, which are employed by the auditor to identify and assess the risks of material misstatement. Again, the same thing, but worded in different form. The procedures which are employed by the auditor to identify and assess the risks of material misstatement, whether due to error or fraud, are known as risk assessment procedures. So, first of all, guys, what could be kind of risk assessment procedures? What could be the examples of risk assessment procedures? Say, guys, there are three kinds of risk assessment procedures which are used by the auditor. Number one, inquiries of management and persons within the entity. And number two, analytical procedures. And number three is observation and inspection. Now we come to the first thing, inquiries of management and persons within the entity. Now the auditor has to identify and assess the risks. Now how he can do it? How he can do it? Obviously, he has to seek information from management and from other persons who are responsible for day-to-day working of the entity. Say if the auditor wants to know that if there are some pending litigation cases against a company, or whether the company has filed some suit against some other third persons. So what is the mechanism with the auditor of knowing this? Obviously, he has to seek this information. He has to inquire this information from the legal department of the company, or from the legal counsel of the company, from the legal counsel, which is the head of the legal department of the company. Okay. Similarly, if the say auditor wants to know about the quality control system of the product being manufactured by the company, then how he can know? He has to go to the quality control personnel and he has to understand those things. Similarly, if the auditor wants to know about the future sale position of the company, then whom he has to contact? He has to contact the marketing personnel. He has to contact the sales department to know what is the position of orders of the company, whether the company has sufficient orders or not. Okay. So inquiry of management and persons within the entity. So this is one type through which the auditor identifies and assesses the risks. Okay, so this is one type of risk assessment procedures, inquiries of management and persons within the organization, within the company, within the entity. Okay, so that is clear, guys. So unless the auditor inquires something from people within the organization, he would not be able to identify and assess the risk. He will not be able to pinpoint those areas where there could be possibility of potential misstatements. Okay, guys. So is that clear? Tell me, guys, is that clear? You have also studied in chapter 3 that inquiry is a form of audit procedure. Haven't you? You remember inquiry is a kind of audit procedure. So the auditor inquires from management and persons within the entity to identify and assess the risk, to perform risk assessment procedures. Is that clear, guys? And second thing is analytical procedures. We would be coming later to analytical procedures. First, we would be going through observation and inspection. Now, guys, you also understand observation and inspection. You have also done in chapter 3. These are also kind of audit procedures, observation and inspection. So now tell me, guys, tell me, students, what is the difference between observation and inspection? Can you give some example? Can you give some example of a company and I see certain annual reports, past annual reports, I see certain documents of the company, I see certain forecasts of the company. So what kind of audit procedure it is? Is it observation or is it inspection? Tell me. Is it observation or whether it is observation or whether it is inspection? Tell me. Whether it is observation or it is inspection. Only 2-3 mails have come. Harsh Goyal, Shivam Kumar. Whether it is when the auditor goes through some documents, whether it is observation or whether it is inspection. So as it is known as inspection, when we go through some documents, it is known as inspection. Not only when we visit the plant of the company, when we go to the plant of the company, it is also an inspection. Okay. So either when we see the documents, we go through the reports, or when we visit the plant of the company, we visit the premises of the company, we go to the site, actual site, we go to the building. So it is inspection. Okay. And what is observation? Then what is observation? What is observation? So observation means to observe some process performed by others. Observe means to see some process being performed by others. Say when the auditor, he is physically verifying the stocks. So he is and the people of the company are assisting him. Okay, they are performing some procedures, they are counting something, and the auditor is observing. So he is observation and inspection. These are also risk assessment procedures. These are also from studying the documents. Now I study the documents which have been put up before me. My mind is making some assessments. I can identify where things can go wrong. What could be the potential areas of misstatements? Okay, so similarly, when I observe some procedure being performed by another person, so I can observe that this procedure is being not performed proper way, or what could be the likelihood of some fraud being conducted. So both these observation and inspection risk assessment procedures also. These are audit procedures, but these are also risk assessment procedures. Okay, guys. So is that clear to you? Observation and inspection clear to you guys? Now, third thing is analytical procedures. Now, what is analytical procedures? Analytical procedures. Students, there is a complete chapter on analytical procedures within module 1. So you would be studying in quite detail what is meant by analytical procedures. For the time being, you can understand that analytical procedure means those kind of procedures which are employed by the auditor to evaluate the relationship between financial data and also non-financial data. Okay, say we can understand it with the help of an example. Say if the installed capacity for manufacturing articles of a company is 5 lakh per annum. It is 5 lakh per annum. In I think you are able to see me now, guys. The link had snapped. Are you able to see me? Is now audio video clear again, guys? The link had snapped. Are you able to see me now? Please let me know so that we can start again. Yes, guys. So let us assume that the installed capacity is 5 lakhs per annum for manufacturing of an article and sales price is rupees 1000 per article. Okay. Then simple back of the envelope calculation shows that sales of the company cannot be more than 50 crores. So the auditor, he evaluates the relationship between financial data and not only between financial data but also between financial data and non-financial data. Okay, so these kind of things like ratio analysis, these kind of things are known as risk. These kind of things are known as analytical procedure. By making an analysis of from the various financial information and between financial information and also non-financial information, we can identify the potential misstatements. We can identify the areas of potential misstatements where there is a more likelihood of misstatements, where there is a more chance of misstatements. Okay, so these are known as analytical procedures. As I have already told you, there is a complete last chapter in this module relating to analytical procedures. You would be studying analytical procedures in detail there also. Okay. Number one, it is inquiries of management and persons within the organization. Okay, so from different examples we have already discussed that the auditor can seek information from any departments and he can pinpoint areas where misstatements can occur, where there is a possibility of misstatements occurring. Okay. And second is analytical procedures. By deploying analytical procedures, by comparing various figures and by making overall calculations, he can whether the assertions made by the management in the financial statements are correct or not, or what is the probability of misstatements in those financial statements. Okay. And third is by observation and inspection, that we have already discussed, that by inspecting some documents or inspecting the physical facilities, okay, we can also pinpoint the areas Yeah, there is buffering happening, guys, due to some connectivity issues. So I think you have understood uh, all three kinds of risk assessment procedures. Okay, you have understood this example also. Now, guys, when one more logical question arises from this, that why understanding the entity is important, or how does understanding the entity help the auditor. Okay, how does understanding the entity help an auditor? Affair, it is a continuous process. Okay, and how does it help the auditor? It helps the auditor in many ways. It helps the auditor in identifying potential misstatements. It also helps the auditor in determining materiality, what things are significant. Because if the auditor does not understand the entity, its operation, the industry in which it's operating, or what the controls it has employed, he has not studied the internal control system, then how he can arrive at the materiality. So the understanding the organization, its business, helps the auditor um, in determining materiality in relation to auditing. Okay, and understanding the entity also helps the auditor uh, to see whether the organization has employed correct accounting policy or not, whether the company is following correct accounting policies or not, which are very important for the point from the point of view of preparation of financial statements. So, so therefore, this process of understanding the organization is very important for the auditor, and it helps him in many ways. So all these points, all these 4 or 5 points are written in your module. Okay. So now the next question arises. We have we have understood about the risk assessment procedures are there, and we have also know today connection is buffering too much. So then next logical question comes, how do we understand different phases by seeing the previous reports, by review of financial performance and all that? So guys, what we have done till now, we will also be going through the module. So I would be sharing the module screen with you. You are able to see the screen, guys? You are able to see the screen, guys? You are able to hear my voice? Now, we are at point number 2, identifying and assessing the risk of material misstatement. Now, as per SA 3, identify and assess the risk of material misstatement, whether due to fraud or due to error at the financial statement and assertion levels. Both things are important at the financial statement level and at the assertion level, including entities' internal control and what auditor has identified and assessed the risk. Now he has to design response. Now what does this mean, designing responses? It means that auditor has to choose what kind of audit procedures he has to employ. Okay, so he has to design his response. He has to consider that what kind of audit, considering the probability, considering the likelihood of his statements, what kind of procedures he has to employ. Okay, now we go to next subtopic. Now, the auditor shall identify and assess the risk of material misstatement at both financial statement level and at assertion level. Okay, now the 4 things, these you have to remember. 4 things he has to do is number 1, number 2, number 3, and 4. Number 1 is this we have done, identify risk throughout the process of obtaining and understanding the entity. When he understands the entity, what is its nature of business, how is it operating, then he has to identify the risk throughout the process. What could go wrong? What is the possibility? What is the chance of misstatement occurring? Okay. And second is assess the identified risk and evaluate he has identified the risks. Now he has to evaluate whether these risks relate to financial statements as a whole pervasively. These are affecting many assertions, or these reflect only few account balances or only one account balance. So he can make whether how significant the possibility of misstatement is. Okay. Third is relate the identified risk to what can go wrong at the assertion level, taking account of relevant controls that the auditor intends to test. Relate the identified risks. Now, the identified risk has to be related to what can go wrong. Now he has to assess what can go wrong at the assertion level. Okay, and thereafter he has to consider likelihood of misstatement. Okay, guys. I know, guys, that there are internet connectivity issues. I have already talked to uh, the technology guy, and he is saying that it is service provider problem. Okay. So what are risk assessment procedures? I think you are bearing risk assessment procedures. So the audit procedures which are performed by the auditor to understand the entity and its environment, including its internal controls. You have to understand that study of internal control is very much the part of understanding the entity, because unless the auditor is able to understand the internal control system, the controls deployed by the management, then he will not be able to gain a good understanding of the organization and its operations. Okay. And what are the risk assessment procedures? So there is one more para, that risk assessment procedures. These may be used as audit evidence to support assessment of risk of material misstatement. In addition, the auditor can obtain evidence about transactions even though such procedures were not specifically planned as substantive procedures. Now, what does this mean, guys? This means, say, as part of risk assessment procedures, as part of this exercise, the auditor has come to the notice of auditor certain things. Although he has still not started the detailed checking, he has still not started substantive checking, but by virtue of risk assessment procedures, something has come to his knowledge. So although he has still not started substantive procedure, substantive checking, still the information which he has gathered through risk assessment procedures, he can use this as an audit evidence. Okay. And again, the same thing, this is repeating many times. The risk to be assessed include both due to error and fraud. I have also repeated it n number of times today that misstatements can relate to error or fraud, and consequently the risk to be assessed also include both due to error or fraud. Okay. And then there are three kinds of risk assessment procedures: inquiries of management, analytical procedure, observation and inspection. All the three things we have discussed: inquiries of management, analytical procedure, and observation and inspection. Okay. So these are some examples are given: inquiries of management and others within the entity. So like I have already told you, inquiries directed towards those charged with governance, inquiries with purchase personnel towards in-house legal counsel. This we had already discussed. Okay. Inquiries towards marketing or sales personnel. So on. So these are examples. Analytical procedures, this we have already discussed. Observation and inspection. Okay. So observation and inspection, this we have discussed. These may support inquiries of management and may provide information about the entity. So here below examples are also given. Now documents, reports, entities, premises and plant facilities. Okay. The entities operations. So these are examples of observation and inspection. Now this is entities, premises and plant facilities. What is this? This is inspection. And documents, when an auditor sees the documents, again this is an inspection. Reports prepared by the management, this is also inspection. And when the auditor sees the procedures being performed by others, it is known as observation. Okay. And I would like to tell you guys that this question give examples of some risk assessment procedures, some type of this question, 4-mark or 3-mark question. This question has recently come in the exams in the last attempt, I think, or in the previous last attempt. Okay. So guys, while you are preparing, you have to remember that all questions are coming from your modules. Nothing is going to come in your examination outside your modules. So whatever the module is available on the ICAI website, whatever the study material has been provided by you to the by the Board of Studies, all your paper, all questions are framed from this study material only. Okay. This is not only true for auditing, but also for other subjects also. And understanding of the entity, it is a continuous process. This we have also done. And how does understanding the entity helps the auditor? It helps the auditor in assessing risk of material misstatement, determining materiality, considering appropriateness of selection and application of accounting policies. Okay, and so on. Such things. Okay, guys, is that clear? Is that clear, guys? So these things. So guys, tell me, are you in a mind frame? Are you in a mood to do few MCQs? Tell me, guys, are you in a right frame of mind to do some MCQs so that I can share the screen with you? Please post your mails, post your replies, guys. Please post your replies, guys. Are you in a right frame of mind to do few MCQs of what we have studied up till now? Please tell me, guys. I am waiting for your response. I am waiting for your response. Are you in a right frame of mind now to do some MCQs? So majority of you are saying yes. So obviously the majority opinion should prevail. Few are saying no also. To them also, my request is just listen. If you are in a mood, you can answer. Otherwise, you can skip. Okay. Okay, guys. So I am sharing the screen. Yes. The screen is visible to you guys. Now, this is the first question. This is the first question. Identify the most appropriate option. The auditor of a company assesses inherent risk and control risk to be high. In such a situation, how should he likely design audit procedures? Which option should be correct? Which option should be correct? Tell me, guys, what should be the correct option? The auditor perceives inherent risk and control risk to be high. The auditor is of the opinion that inherent risk is quite high in the organization and control risk is also high. Now, how he should likely design the audit procedures? Send me your answers. Only 3 mails till now. Only 3 mails till now. Tell me the answer. Yes, I am waiting for your responses, guys. ऑडिटर ने असेस किया है कि इनहेरेंट रिस्क और कंट्रोल रिस्क हाई है, तो उसके ऑडिट प्रोसीजर कैसे होने चाहिए? आपके पास 4 ऑप्शन दी गई हैं, उसके ऑडिट प्रोसीजर्स कैसे होने चाहिए? जरा ध्यान से आंसर कीजिए, प्लीज आंसर केयरफुली गाइस. Yes, now few answers have come. So the correct option is, some of you, I think, more than 60% of you guys who have replied, they have answered it correctly. And the answer is this: C. The audit procedure should be extensive and widespread to keep audit risk low. Now, inherent risk high है, control risk भी high है, तो auditor obviously then it is very risky affair. So auditor perceives it is a very risky affair. Obviously, I had told you that he would increase his area of checking. So the audit procedures should be extensive and widespread to keep audit risk low. Audit risk तो वो low ही रखना चाहेगा. He would try to keep audit risk low. He would try to save his skin. He would be concerned that his audit does not fail. Okay, guys? He would be concerned that his audit does not fail. So the audit provides the assurance which it is intended to provide. So कुछ लोग इसमें गूगली खा गए, उन्होंने ए मार्क कर दिया. अब ए में क्या है? ऑडिट प्रोसीजर एक्सटेंसिव और वाइड स्प्रेड तो है, लेकिन टू कीप ऑडिट रिस्क हाई लिखा है. सो दैट इज व्हाई आई एम टेलिंग यू, यू हैव टू read between the lines and mark the answers carefully. No auditor would like to keep his audit risk high. If you are auditor of a company, why would you like to keep your audit risk as high? You would like to keep audit risk as high. You want your audit to be treated as failure? No auditor would want his audit to be treated as failure, of being charged with expressing an inappropriate opinion. Okay, so he would try that audit procedures should be extensive and widespread to keep audit risk low. Okay, so is that clear, guys? Is that clear to everybody, guys? The concept is clear to you, everybody, guys? Now we move on to question number 2. Now it is a fairly simple one. Which of the following statements is incorrect regarding audit risk? Now 4 statements are given. Answer carefully, mark carefully. Which of the following statements is incorrect regarding incorrect? You have to mark incorrect, not correct, incorrect. Which of the following statements is incorrect regarding audit risk? What should be the answer? कौन सी इन चारों में से स्टेटमेंट गलत है? इन चारों में से कौन सी स्टेटमेंट गलत है? Which of the following statements is incorrect? Tell me, guys. Only 2 males. Only 2 males till now, guys. Tell me, which of the following statements is incorrect regarding audit risk? Yes, some of you are answering correctly. The correct answer is option B. This is incorrect. So that is why, look, it has to be arrived at using logical methods and quantified. Again, googly, I had told you that audit risk is not necessarily to be quantified. It is not capable of precise measurement. Auditor can make a subjective judgment. The audit risk that he can make a subjective judgment. Audit risk has to be low, or audit these kind of things. He has not to arrive at some figure or some quantity by using some method. All other statements are correct. It is a matter of professional judgment of auditor. It does not include risk of litigation or reputation of loss, and option A also. Okay, so option B is correct. B is the right answer. So many of you have written correctly. Bikash Ghosh has written correctly, and many others. And now we come to question number 3. Now, question number 3 is, which of the following is generally not part of risk assessment procedures? Now tell me, guys, fairly simple, straightforward question. Fairly simple, straightforward question. Question number 3. Only one male. Question number 3. Which of the following is generally not part of risk assessment procedure? Only one male till now. Yes, guys, come on. Come on, guys, you can do it. You can do it, guys. Which is not, again, see, you have to tell that option which is not part of risk assessment procedures. Yes. Very good. Congrats to all of you. Everybody has answered it correctly. So the correct answer is re-performance. Re-performance. This is not part of observation, is part of risk assessment procedure. Inspection is also, and inquiries of persons within entity also. Okay. And fourth question is this. Which of the following is not a factor for considering relevance of control to audit? Guys, we have not done this thing in greater detail. However, you can make a reasoned guess. You can make a reasoned guess of what could be the answer. The question is fairly simple. Whether the control is relevant to audit or not. So what could be the factor? What could be the factor? We will be studying this aspect in our next lecture. So you can, for the time being, you can skip the question. You might not be able to answer. You can skip the question. Anyway, the answer is D. Answer is D, and I would again explain it to you how it is so. Now this is the last question, question number 5. Question number 5. Consider the following statements regarding audit risk and its components. This is also fairly simple. We have discussed it many times today. Which of the options is appropriate? You have been given 2 statements and you have to answer which of the options is appropriate. 2 statements are given, statement 1 and statement 2. Either both are correct or one is correct and one is incorrect. Tell me, guys. Tell me, guys, only 2-3 mails. What should be the answer? What should be the answer? Now, guys, statement 1 states control risk can be reduced but not eliminated completely. This statement is correct. We have already discussed that control risk cannot be eliminated completely because some risk would always be there, that somebody might bypass the control. And statement 2 states that detection risk can be eliminated completely with design of sophisticated procedures. I had already told you that detection risk also cannot be eliminated. It cannot be eliminated. Some detection risk of not detecting material misstatement would always remain. However, sophisticated audit procedures an auditor may design, but some risk of detecting material misstatement would always remain. So otherwise audit risk would be zero. But we have already understood that audit risk cannot be zero. So that is why there would always be some control risk, some detection risk, some inherent risk. Okay, so the correct option is option B. Statement 1 is correct, whereas statement 2 is incorrect. So Khushi and Sushil Kumar Barak and many others have answered it correctly. So guys, I hope that you have understood the concept of audit risk and its components and relationship between the components of audit risk uh, fairly well. And you should try to read the module and correlate with what you have learned today with the module and try to solve the examples and back exercises also, so as to ensure that these things and these concepts are ingrained in your mind. Okay, so that should be your strategy. And again, we are sorry for inconvenience caused to many of you due to some connectivity issues, but these issues pertain to service provider, and obviously we have to live with these. Okay guys, so best of luck and good night, and we'll be meeting again day after tomorrow on Wednesday. Okay, thank you guys, thank you so much for listening patiently. Okay guys.